emerging markets and gold will beat the dollar. So you seem to think that our easing is going to beat their easing. Is that a correct way of looking at it?
There's a couple different things going on. I think our easing will actually beat their easing in terms of the fact that we're not actually going to be doing anything, but we are adding money into the markets. They will potentially be reducing their rates more. But I think net, that additive inflow into the markets of money from the Fed will be like an ease.
From the NXT studios in Southern California, this is the Power and Market Report. I'm Albert Liu. I'm joined today by Nomi Prins, the author of Collusion. The journalist and former managing director of Goldman Sachs will be the keynote speaker at the coming 2020 Sprott Symposium on Natural Resources. Nomi, thanks for joining me again. How are you?
I'm doing great. Thank you so much for having me on.
It's great to have you on again. And, I really enjoyed your recent article, The Soaring 20s to Start the New Year. I think it was a great way to kick off this new year. 10 economic and market trends to consider for 2020. So let's start with just an overview. What do you think the backdrop, the overall, before we get into the details, the overall backdrop for 2020 is going to be? We had a tremendous 2019. Is there going to be more of that?
I actually think there is, and I'm generally a fairly skeptical person, but I also like to look at the data. And what we saw towards the end of last year, and actually throughout most of last year, was the Fed retreating from its hawkish stance in 2018 and moving very quickly to a more accommodative stance with 3 rate cuts. But it wasn't just the Fed doing rate cuts. The Fed also opened up its balance sheet a little bit more, threw a little bit more money. Actually, when I say a little bit more, $500 billion worth more money into the markets through repo operations, meaning short-term loans to the banking community and to the communities they service from a corporate standpoint. All of that helped to not just lift the markets because the extra money was coming in, which we've seen in some of the years in the past decade as well, but also because of the confidence that the markets then could have that the Fed would be there. That if the Fed needed to, it would find ways. They might not be rate cuts. They might not be conventional QE, but they'd be this sort of backhand QE through the repo markets. And not just the Fed, but central banks around the world. And not just the main central banks, but a lot of the emerging market central banks and the sort of medium to smaller form of economies throughout the world switched to their own accommodative states for their own reasons. And that's something relatively new. So we had almost a 3-to-1 number of central banks and emerging markets find some form of either rate reduction or other accommodative way to alter their money cost in their own countries throughout the world. All of that culminates into a generally bullish backdrop, I think, going forward into this year.
Yeah, I couldn't agree with you more. That reversal was key last year in that, strong double-digit return. Powell talked a tough game, but when it came down to it, he really gave in. What do you think, if anything, could make him retreat yet again in reverse direction in 2020?
In terms of becoming hawkish again, I think it would take an amount of inflation in real prices that I don't think we're going to see. And even if we see it, I think it's going to be difficult for him to act on it because there's a lot of chatter within the Fed, and there has been actually the last few years, about whether their inflation targets even make sense. And whether or not the 2% level is the right level to even start to worry about. So before we would even get to a 2% level, which we don't have in terms of real price appreciation, but even if we did, there I think would be more talks within the Fed as to whether that was meaningful. And so I think that's going to keep the Fed pretty much in limbo. And also, again, we have U.S. elections coming up towards the end of the year. There's going to be a lot of focus on that. And plus, other emerging market and other types of economies have their central banks also on a neutral to accommodative stance. So I think they would have to overcome a lot of data to get back to a particularly hawkish stance or even to raise rates this year.
Yeah, I find myself in this strange position, not of just agreeing with you. We agree quite often, but coming around and sort of seeing it the way that the consensus is looking at it, and that is that all the things are lined up for another good year. And I say that reluctantly because of the underlying problems we have in the economy. But I really think you're right. And they've already sort of left the door open or cracked the door open to sort of repondering, reconsidering that 2% threshold, but just saying that they want a symmetric 2%, which means they can overshoot. So, I totally agree with you in that. Now, another point you made was about emerging markets, and this also came up in your article. Emerging markets and gold will beat the dollar. So you seem to think that our easing is going to beat their easing. Is that a correct way of looking at it?
There's a couple different things going on. I think our easing will actually beat their easing in terms of the fact that we're not actually going to be doing anything, but we are adding money into the markets. They will potentially be reducing their rates more. But I think net, that additive inflow into the markets of money from the Fed will be like an ease, right? So not to get complicated on that, emerging markets have less tools because they have less balance sheet capabilities to take on, the sort of debt or other things in their own country. So it'll be two different kinds of easing. So yes, we will be, because we're opening the Fed's balance sheet and it's growing, easing by more than emerging markets will. But emerging markets will be easing, and that's going to stimulate their markets and potentially their economies, although I generally don't believe there's a real relationship between economic growth and market growth, but it will have it will provide the perception throughout the world of market growth, which will bring in capital into emerging market countries. So it's sort of like there's two different reasons, but together it means the dollar should weaken relative to emerging market currencies. Emerging markets in general on a stock basis should outperform the U.S., and gold should outperform potentially both.
Oh, that's interesting. So I was going to ask you about that. Gold, the dollar has been strong for quite some time now. It's reasonable to expect that would turn around. But you think gold relative to other currencies would be a good bet this year?
Yes, because of that implicit and explicit easing that will be happening with respect to all these other currencies. The Fed opened the door for these other emerging markets to ease their monetary policies. And as such, relative to those currencies, gold will also be able to outperform as they outperform the dollar. So the relationships, I think, into this year are going to be really interesting from that perspective. It's not 100% intuitive, but that's what I see.
Okay, another point you make here: corporate bond markets will expand. You think that the environment is going to be ripe for continuing issuance, these low rates?
Yeah, and again, I think that's going to be a pretty much global type of thing that's going to happen. It's going to be more corporate debt issuance in the U.S., in the major economies, as well as in the emerging market economies, because, again, they're reducing the cost of their money, so their corporate issuance is going to basically increase. The corporate issuance in general has been in an upward trend in the U.S. and other major economies. That's going to continue because rates themselves are not going to be moving up. So in general, the overhang of debt that we have globally, which will ultimately be a problem. This is still ultimately a crisis that's being pushed off, all of this debt, but I believe this year we're going to hit more record debt on an absolute global basis, and then also in all the individual economies relative to their GDP, relative to their growth.
Yeah, you highlight a very, critical problem, and that is the amount of corporate issuance we've had. You started the article with a quote from F. Scott Fitzgerald's wife pertaining to the 1920s. We couldn't go on indefinitely being swept off our feet. And that's what's been happening now. We've been swept off our feet for many years in a row, and it's been a great environment to issue debt. But more and more, this is becoming a problem. We can't have, levering up forever, corporate buybacks forever. And what I'm wondering is, how is this going to play out? Because on the one hand, we can't keep doing this, and there's going to be some type of crisis in that market. On the other hand, the government sort of needs negative real interest rates forever so that they can keep borrowing. So how is this going to play out? Are these spreads going to just blow out spectacularly, or what's going to happen?
ultimately, that's what will happen. So the question is, when will that happen, and what will be the cause of that happening? You and I have talked for years about the fact that there's too much debt in the world as it continues to increase. And what we saw last year is that the ability for debt to increase at what is now a more accommodative interest rate pattern globally than it was in 2018 or 2017 just has made it increase by more. And because there's no real impetus to raise rates at this point, this is going to be, again, a year of increasing of debt. But at what point does the fact that companies and countries are not growing as fast as their debt is growing come to a head? I think that will happen through more sort of extraneous circumstances, like when we saw the assassination of the Iranian general by the U.S., and then the world was waiting whether Iran would retaliate. How would they retaliate? And then Iran sent a bunch of missiles to attack some Iraqi bases with U.S. personnel there. Nobody was hurt. But all of those kinds of unforeseeable yet actually potential, if you think about it, phenomenon could be the things that actually come in and make countries get a little more tense in terms of their debt versus their growth scenarios, and investors more tense and money retreat, and therefore spreads blow out. But I think it's very periodic. The market really digested that whole event really, really quickly. Another market a year ago, or a year and a bit ago, when the Fed was still in raising rates mode, that would have, had a 500, 600 point drop on the Dow just with that activity, and it had a few hundred points, but most of them popped right back up. And so there's a resilience there. At some point, though, those activities with that much debt will cause a crisis, and I think it's going to be when we finally get to leaving this current accommodative period into more tension. Will there be raising rates? I don't think, again, it'll be this year, but let's say it's next year or the year after. And then you have those factors. And then let's say the trade agreement that was just signed, the phase one of the agreement between the U.S. and China, which was just signed, is digested, and then concerns say grows for phase two. When will that happen? Will that happen? Will that happen before the election? If it does happen, will it mean anything? Will China then do something to really annoy the United States? Will Trump get reelected and react accordingly? Then all of that stuff can be a part of a debt crisis.
I guess this is a good thing, but I think I was surprised with, how confident the market was that nothing really bad was going to come of that. Like you mentioned, the Dow did dip, but not nearly as much as you'd think. If you look at oil and gold, which are sort of war futures, if you will, they didn't really react very much. So the market took it really well. In fact, the market is more concerned about things like tariffs, China tariffs, and other things like, the way Jerome Powell is leaning, much more so than the prospect of war. How do you interpret that? Is that a good thing?
Well, all of this, even us talking about the sort of bullish tone we're in right now, does not mean that this is like a natural sort of period of time. We have a tremendous amount of support for the markets coming from central banks. That's just weird historically, but it is the case. And that's why markets care more about money and the cost of money that's coming into them. And if you have enough money, markets feel that they can overcome things like, missile strikes. And obviously, if there is an outbreak of a real wartime situation, the markets would digest that. But what they're doing is thinking, all right, well, that was a thing. We were worried for a minute, but you know what? It didn't really get too awful at that moment. Oil prices spiked. They came back down. Everything's sort of okay, and the money is flowing. I think it would be more of an issue if Jerome Powell were to turn around and be like, you know what, we're done with repo operations. I think that would make the markets upset. As opposed to missile attacks in Iraq, which is a little scary, actually, for the world, because what it means is that the markets kind of don't care as much as maybe markets should if they're really reflective of opinion and reflective of economies and geopolitics, but they're more reflective of monetary policy, and they're getting that gift right now. And so it's kind of like sort of placebo in terms of any types of nerves that what will come in, just sort of like take this, be calm, handle it, and sort of don't worry too much. And that's how they're feeling at the moment.
You mentioned Jerome Powell and his repo operations, hundreds of billions of dollars. They've made a point of saying that explicitly this is not the same as QE. And, maybe technically they're correct. The market certainly, if you look at their enthusiasm, is not buying that. And at the end of the day, dollars and credit are, to a great extent, they're fungible. And so that credit is going somewhere to purchase something. So it certainly does look like QE in terms of the end result of that. What do you think is coming in the next quarter or two? Are we going to get a standing repo facility? If we don't get something like that, is the market going to have a tantrum? What do you see coming?
I actually think both of those things. I think the markets would have a tantrum if it didn't continue, and I think it's going to continue. Because right now I think Jerome Powell has positioned and the Fed has positioned itself to give a certain amount of money to the markets on a monthly basis. That's what the markets are expecting. The Fed knows the markets are expecting that. And I think it's going to continue, which is one of the reasons why throughout the latter part of last year, actually they were increasing their repo operations above effectively the $60 billion per month that they had said they would be injecting into the markets. And so net, when you look at what's completely been injected on their balance sheet, it's gone from $3.7 trillion in the end of August, beginning of September, before they started the Fed, the repo operations, and now it's up at $4.1 trillion. And they've also completely stopped talking about any type of quantitative tightening on the longer end of the curve. So the only thing that's happened, whatever you call it, I call it quantitative easing at the lower end of the curve, because that's what's happening. Money is coming into the markets in return for short-term securities. That is quantitative easing at the low end of the curve. And the reason why the market and banks and so forth understand it that way is because they're just getting the money. And whether that money gets used to back longer-term debt or longer-term issuance or an IPO or some part of another transaction, an M&A or anything else, that short-term money is still there to provide the funding. So I don't see the Fed changing that, certainly in the first quarter, because there's no real point. And they're not seeing any inflationary, I think, data that would warrant them to do that. And I think the market and the banks would get very upset. I think, it's hard in these markets to project too far ahead if we have, sort of extraneous circumstances. But if we do, I think they would be more negative than positive, like, potential increase in tension in the Middle East or a screw up with phase 2 of the U.S.-China trade negotiations or something like that, which would actually cause the Fed to not discontinue repo operations. So I just see them continuing, if I had to put a number in, I would say at least through the first half of the year.
And what's to say it can't go on longer than that? I mean, these guys never cease to amaze me.
Right. The only thing that I would say that could make it not go on more than that, or at least not have the experiment sort of stop at that time, is that if you look at the trajectory of how much money has been going into the markets through these repo operations since September, is they would be back above their highest height of a balance sheet since the financial crisis if they actually continued more than sort of July, August. So we'll see what happens. But I think there might be a natural psychological Fed-like boundary of, there is no actual crisis now. So if our balance sheet actually looks like it's bigger than an actual crisis, that's kind of an odd credibility gap thing. So I think there might be that natural stop. But I think they can go to that point. I just think someone in there would be like, hey, wait a minute, we're getting to that point. Should we just stop? And I think
right.
Likely, so that time horizon kind of matches that value.
And finally, you talk about inequality, wealth inequality, and we're in an election year. I expect this will be talked about often, frequently. So what do you think the issue there is in terms of markets and how the markets are going to react or be impacted by this?
Again, from a market standpoint, as long as the money is coming in, they'll continue to sort of inhale it. Banks will inhale it. It'll transfer itself into debt. But what happens on the ground, and why inequality continues to grow, is that that's done on a percentage basis. There are fewer participants in the market, then the value of the market is increasing. So most citizens in most countries have zero positive outcome from the market going up, and they know this. As debt increases, and as public debt increases, as treasury debt and Japanese government debt in the European Union, debt in emerging markets increase, it means there's less money left to sort of go into infrastructure growth and into sort of cultural programs, into education, into health, into things that governments would otherwise potentially fund, which means that for people living on the margin, their ability to get things without having to pay more for them when they're not making more on the margin is that much harder. And so that tends to result in some of the things that we're seeing is in civil unrest around the world because of that economic inequality, because of austerity programs, because of just money being used for financial assets and not for sort of citizen assets. And that's one of the reasons that led to what is going on in Hong Kong, Venezuela, the Middle East in parts, potentially in the U.S. into the election, probably in a more subdued manner because we tend to be more subdued in some of the demonstrations that happen in the United States on a relative global basis. But I think that that inequality growth does manifest in the civil unrest and in how people vote as well. We saw that, I think, in general, with the UK voting sort of very strongly for Boris Johnson's party, because the Conservative Party, because they did not believe that the Labour Party was offering them a way out of inequality. So why not just, I'm oversimplifying, it's a larger conversation, but stick with what we have, decrease uncertainty into Brexit and let's just move on. But that's not necessarily good for them economically. So I just think there's going to be more instability throughout people at the middle and lower echelons of just, money and society as the markets go up.
So we've heard some of that in the early phases of the Democratic primary. How much traction do you think they'll get on that in the election? And then I guess I'll ask you to predict now. What do you think? Where do you think the election is going?
So I think that from the standpoint of inequality, I think the Trump administration is going to obviously downplay that because there are certain numbers that look good on the surface, like the level of the stock market being high, like unemployment being
right.
Like average wages going up, even though that doesn't mean people aren't working multiple jobs and don't have higher costs in their own households. So I think from the perspective of how that story plays out, the Republican Party and the Trump administration will do everything they can to really just underscore the positive elements of a general economic health, whereas the Democrats are going to continue to highlight what their constituents are saying and what the rest of the numbers bear out, that even if on average certain things look good, like the market or unemployment, the struggle is still there. And the sort of inequality just deepens that struggle. And how do we, sort of understand that that's what citizens are actually sort of thinking about on a regular basis? And then the extent to which they can talk to people and give them real solutions and real platforms, that will be something else. I do think it resonates with a lot of voters, not just Democrats, but I think even on middle Republicans who have problems making their bills or meeting their bills on a monthly basis, that things are more expensive than the overall markets and the overall sort of economic health rhetoric might indicate. So, I mean, we're going to find out in the next month or so, I think, what's going to happen on the Democratic side. I do think, if Biden continues to be the front runner and becomes the ultimate candidate, I think he will talk about inequality. I think he'll more talk about the sort of problems of what has been happening in the last couple of years with respect to trade, with respect to war, et cetera, et cetera. I think if Bernie Sanders becomes the candidate, he's going to continue to talk about who's getting the money. That it is Wall Street relative to Main Street, and resonate with people who are feeling that in their own lives in that manner. In terms of who wins in November, it's hard to say. I mean, there's a strong tendency to vote for an incumbent president or for an incumbent president to win in the second term, unless there's a major economic downfall going on. For example, George Bush did not win a second term because there was a major recession going on as he was working towards being reelected. So given that on the outside, the economy still has a lot of positive sort of numbers that are played repeatedly, that could move the line over to reelecting President Trump. So, but I think we have yet to see the story of how people in the sort of swing states resonate with the candidate when there's only one candidate on the Democratic side and not 6 or 7 that are still running. I think it will become a lot clearer as to what people are going to support. Will they support healthcare for all type of thing where they can actually have that comfort on the healthcare side and that comfort on student loan side? I mean, there are debt problems, there are cost problems that do need to be resolved. Whoever is going to run the country come next year. And I do think voters on both sides of the equation want to know what those solutions really are.
Unfortunately, we're out of time now, Nomi. Thank you very much for joining me on the show. I really appreciate all of your insights, and I'm really looking forward to speaking with you again and seeing you in Vancouver at the Sprott Symposium this July. Please visit Nomi at nomiprins.com and on Twitter at Nomi Prins. Nomi, once again, great to see you, to catch up. Thank you very much, and I hope we can do it again soon.
Yeah, thank you. And I look forward to Vancouver. I'm really excited.